Hello, everyone, and welcome back to the PetroNerds podcast. My name is Trisha Curtis. I'm the CEO of PetroNerds and the host of the PetroNerds podcast, and I am super pumped and delighted to be with you here. This is episode 143 of the PetroNerds podcast, and it is Wednesday evening. It's about 6:35 p.m. on October 22nd, 2025. So we have a considerable little jump up in oil prices, and this is important because we've had so much pessimism around oil in the past couple weeks. And I've cautioned clients and I've cautioned a lot of folks I've been speaking with that I thought this pessimism was overdone. Not because we couldn't trade oil down further when we were seeing $57 and change and that traders couldn't do this, but because there was so much geopolitical risk in the market that has not gone away and that was being really, really discounted. And so what you've seen is an incredible amount of fear and gut and pessimism and algorithmic trading and sell button on trading. And what you're seeing tonight is a reversal of that. And so we've really seen this pick up in Brent. If you were following what's happening in the news, it just happened kind of after the close of the market and this evening. But this is based on the U.S. government, the Trump administration, and the Department of Treasury putting sanctions on Russian oil companies. So this is big news because it moved the market, and that is telling you a lot about oil, which we'll get into. But right now, we are looking at WTI at $60.17. It keeps notching up every time I check it. And we were coming off, folks, again, of this $57 a barrel, which we saw a couple weeks ago from the Trump post, the Truth Social post, which drove prices down. This was based upon just a few weeks ago when China announced their rare earth export restrictions, and then Trump's response saying that he was going to tariff them and the back and forth. And so all this has been based on that. And I want to remind listeners that when Trump did the Truth Social post, oil prices dropped. The next Monday, that was a Friday, the next Monday, the whole stock market recovered, but oil prices did not. And so there was a disconnect there. And then everybody said, okay, well, it's supposed to be that way because we have this oil on the water. We have a lot of crude oil exports. And so there was a lot of messiness going on within oil. But right now we're at $60 a barrel and 17 cents for WTI, $64.35, a nice little jump up in Brent as of the moment I just checked it, about 6:35 p.m. We've got Henry Hub at $3.46. That's moved up nicely. And we've got the 10-year yield. Big news there is we've got the 10-year yield at $3.953%. So we have the 10-year yield below 4%. That's a big move. Now, that 10-year yield is going to impact the 30-year mortgage rate. So we're going to see a little pressure on that. I'd still say we're in that we're still around 6%. But there's a lot happening there. And so we're also seeing a sell-off in gold. So, and people are getting a little bit anxious about that. You're looking at gold at $4,040 or $4,000 and $4,090 an ounce right now. That is a pullback from the high that hit of $4,305 an ounce just on the 15th of this month. So just a week ago, it hit this all-time high, and it's since reeled back a little bit, probably because it's got a little overly hot. But this podcast and this talk, I'm going to introduce this by talking about these Russian sanctions. I'm going to focus a little bit on talking about what's going on with this. What's the backstory between these Russian sanctions and what's going on with the US and China, because I introduced this in the last podcast that was, if you haven't listened to it, please tune into episode 142. It is literally flying off the shelves. The reviews are awesome. And this is a heavy, heavy hitting talk on peak shale and everything to do with China. This is an interview I was interviewed by Stuart Turley. So please take a listen. This is a great follow on to this. So we're going to give an intro to this. I'm going to keep it short and sweet, or try to, because this podcast, this talk, is I'm really proud of this. It was a really fun, awesome talk. The vibe was really great in the room. And this was recorded on September 17th, 2025 in Fort Worth. And this was a really awesome crowd that we had at Whitley Penn. It was the second conference I did with them of the keynoting, and it just went really, really well. Haley Mitchell, she's an audit manager for Whitley Penn. She was on stage with me. She's the moderator, and she did a really good job with the questions. She listens to the podcast. And so I think it's a treat. I think you're going to love this, because these keynote addresses, the way they're doing them, we get to really dive into stuff a lot deeper than I normally do if I'm just sort of ripping on it. So I'm really looking forward to the reviews, but it was a blast, and there was a lot of really, really good positive feedback from the audience. And you'll hear in the Q&A, you're going to hear some great questions as well. So we kind of cover everything in this podcast. I'll talk about this momentarily before I get into it. But I want to start out with what's going on in the market right now. So these Russian sanctions, which have propped up oil prices, $3 a barrel. Now, important to note on this. If you traded that quickly, that's just trading. So when oil prices moved down, a few weeks ago, and they sold, or a couple weeks ago, and they sold off on the Trump Truth Social post on the rare earth stuff, and then the threats of 100% tariffs, and then later that day he did 100% tariffs on China. If it sold off that and the stock market recovered, but then oil price didn't recover, that's trading. And then it kept off, and then the IEA report came out, the International Energy Agency report, the group out of Paris, that came out and said, hey, we've got a big surplus. And we've known we're going to have a big surplus. But what happened was that the numbers from August to September, the oil on the water rose significantly. And so everybody says, oh my gosh, look at all the oil on the water. That's as much as we've had since COVID. Well, that's true. We've had a lot of oil in the water. However, not the same as COVID, because during COVID, we lost 9 million barrels a day demand in the US, in seconds, right? Not 9 million barrels a day. Totally. We lost several million barrels a day in the US because we stopped driving for a couple of weeks. And so we had a lot of crude oil stocks on land build up in pipelines, all the crude oil storage and everything. We don't have that right now. And actually, if you're following the Strategic Petroleum Reserve, you're seeing a notching higher. It's actually less than 1 million barrels a week that they're adding, but that is being added. And you see China stockpiling like crazy. So those are two things that are really underpinning, I think, and not supporting the thesis that, hey, we're going to go down to 50 in the next few weeks. And traders, like I say, traders can absolutely do that, but I don't think that reflects the supply and demand fundamentals. And right now, the market's telling you it isn't reflecting geopolitical risk, and the market has not been pricing that in appropriately, as I've been saying all year. So what happened was, you saw this headline probably on CNBC. Brent crude jumps 5%, about 5% after Trump administration sanctions big Russian oil companies. So if you listen to that, they did sanction them, but I'm going to read to you what they actually did. So this is from the Treasury, U.S. Department of Treasury, and this is good because this dropped earlier in the day. So the market kind of took a minute to get this, and then what we saw was crude pricing actually as the Asian opened and everything opened. Now you're seeing those moves and those trades on oil given the U.S. close and then the Asian open. So this says, quote, I'm reading from the Department of Treasury and printed out here for you. This is Treasury sanctions major Russian oil companies, calls on Moscow to immediately agree to ceasefire. So what happened was yesterday, you saw in Axios and other articles saying that the Trump-Putin meeting was off. That alone should have moved oil prices higher, and it didn't. But then we got this move up higher. So the Trump-Putin meeting going off. Every time we see oil prices go down and sell, they say, oh, it's recession, or oh, it's the China tariffs in the US, or China trade in the US, or China rare earths in the US. All those are really real. And then they have this peace deal, right? We got a peace deal. We got a ceasefire in Gaza, a peace deal between Hamas and Israel, which I'm not sure we have a necessarily peace deal there. But then it's really, since the Trump Alaska summit, that's what the oil price has been pricing in, is that we have this peace deal and we're going to get a ceasefire. I mean, we are way far from it. And what was really interesting is that there was a very scathing article that came out from the Financial Times after the Trump-Zelensky meeting last week. And it was really biased. I mean, it was like so biased that you knew that it had to be incorrect because they didn't even offer a little peppering of reality in there. And I actually watched the entire meeting. And yes, there were some edgy questions that Zelensky got. He handled them really, really well. But Trump never said, hey, we're not giving you tomahawks. And the article basically says, hey, Trump's not giving him tomahawks. And, it was, he really berated Zelensky, and he basically echoed and parroted everything that he had on a call with Putin. And he even said it wasn't a war. He said it was an incursion. And I thought, this is all ridiculous, right? This is way overblown and clearly quite biased and not truthful. And I think that's what's borne fruit. So what happened was, this dropped today. This is October 22nd, 2025. Quote, today, the U.S. Department of Treasury's Office of Foreign Assets Control, OFAC, is imposing further sanctions as a result of Russia's lack of serious commitment to a peace process to end the war in Ukraine. Today's actions increase pressure on Russia's energy sector and degrade the Kremlin's ability to raise revenue for its war machine and support its weakened economy. The United States will continue to advocate for a peaceful resolution to the war, and permanent peace depends entirely on Russia's willingness to negotiate in good faith. Treasury will continue to use its authorities in support of a peace process. I'm continuing now, and this is a quote on here. So this is quoted. Now it is time to stop. They are quoting. So, Quote, now it is time to stop the killing for an immediate ceasefire, end quote, said Secretary of Treasury Scott Bessent. Quote, given President Putin's refusal to end this senseless war, Treasury is sanctioning Russia's two largest companies that fund the Kremlin's war machine. Treasury is prepared to take further action if necessary to support President Trump's efforts to end yet another war. We encourage our allies to join us in and adhere to these sanctions, end quote. I'm going to keep reading just for a second. Today's actions targets Russia's two largest oil companies, open joint stock company Rosneft Oil Company, Rosneft, and Lukoil, OAO, Lukoil, which are now designated. Rosneft is a vertically integrated energy company specializing in exploration, extraction, production, refining, transport, and sale of petroleum, natural gas, and petroleum products. Lukoil engages in the exploration, production, refining, marketing, and distribution of oil and gas in Russia and internationally. These are the two biggest oil companies in Russia. It's a big move to sanction them. The question is, will they be implemented? But the whole point is that this is in response. This is what you heard from the White House. This is in response to the fact that they weren't getting anywhere with this Trump meeting with Putin in Budapest, which they were supposed to do in a couple weeks, and that clearly they were, Trump talked about in this meeting with Zelensky last week that it could be a trilateral, right, where he could meet with Zelensky, and he was very open to all this. So clearly behind the scenes, a lot fell apart. And so Putin is essentially I'm sure Putin basically just said, yeah, I'll meet. And here's what I'm saying. And they weren't doing anything. And so I think, the US Trump administration is taking this quite seriously, and you're seeing the reaction. I've been saying this for a while, is that this is the bet that the Saudis have made, is that crude is going to get sanctioned. They know the Russians, they work with them. They're in OPEC plus. They know what's going on. And so this is the bet they made. And this might turn out to be a decent bet by the Saudis to add barrels on the market and take back the market share when they know barrels are going to be taken off at some point. It's taken a while for these sanctions to come through, but if they start coming through and they're actually enacted, we're going to see some changes. Okay, so you have that. And then everything's kind of based on all these meetings, right? That Trump was going to meet with Putin, that Trump's going to meet with Xi. We have a lot of stuff going on that's kind of churning under the market, and it's churning. And then every time there's a headline, you see it surface on the stock market with regards to China and the U.S. and these rare earth export restrictions, which are still very much alive right now. And you're seeing every time you turn on the news, if you're watching the stock market in the evening, if you're watching the Middle East Open, you're hearing it talked about in the Middle East. You're hearing folks talk about it in Europe. It's obviously going to the rare earth export restrictions, if implemented to the degree that China says they're going to do it, is going to impact absolutely everyone. So there's a Bloomberg article that came out this evening as well that says, quote, Trump says he'll raise China's Russian oil purchases with Xi. So as of right now, apparently the meeting between Xi and Trump is still on. But in the past couple of days, there has been rumor and talk that the meeting might be off. And that is because right now what you're seeing is that you're seeing all those folks, Bessent and Greer and everyone, and negotiating right now with China. And so there's a lot of back and forth. There's headlines coming out that we are considering, quote, the U.S. considers broad software curbs on China, White House says. So these broad software curbs include a lot of stuff. And Trump has been, every time he gets on TV and he talks about this, he says, we're going to have a meeting. I think it's going to be good. But also we have tariffs and we can do all this stuff. So I would just say put a pin in this, because it's a little bit like this Trump Putin meeting. I think they definitely want it, but they're not going to have the meeting unless they have something to really talk about and really work with. And it's becoming increasingly clear that I think the Chinese are not in the same position of wanting to work with the Trump administration. So I'm going to shout out to a article and op-ed that I did on China. So this is really, really timely. I was actually just in Houston yesterday. And so we actually talked about this on stage. I was at an executive symposium that NGP and TPH hosted in Houston. It's a Chatham House Rules conference, but I was speaking and it was awesome. I was super honored to be invited to speak. And it was really great because I got to have very candid conversation about energy and a very candid conversation about oil and gas and actually coal, which was a real looking at the faces in the audience of talking about coal was very, very interesting. But I talked about this article that I wrote and that I did with the American Energy Institute, which I'm an economist for them. And so I did this article, dropped this week. Really encourage you guys to take a look at this. This is on the Daily Caller. So if you Google Trisha Curtis Daily Caller, you're going to find it. I posted it on LinkedIn, posting it on Substack. It's all over the place. But it's literally Trisha Curtis, semicolon, winning against China means winning on energy. And so this is really, really timely because I give you all the stats and figures and all the stuff I talk about of, China being a modern coal power and having 10,000 terawatt hours of power, and 5,800 of those being in coal. Now, just put that a pin in that and keep that in the backdrop to think about. But this what's happening with this Trump Xi meeting and whether or not this is going to happen. This is all about rare earths, but we're now having increased rhetoric from the Chinese of calling the U.S. a failed state. So in their media, they're calling the U.S. a failed state. They're having their fourth plenum right now, so they're having meetings right now, and so we don't have any transcripts of what Xi Jinping has actually said. But when you're turning on the news and you're listening to it at night and you're following the China feed out of there, what you are seeing is that they're talking about security and strengthening, and there's this kind of and this mantra of security and strengthening and having resolved has been going on for the better part of 5 years. It's really kind of these COVID era measures, but I think we have to keep that in context of what's actually happening. And the reason I shout out to the article, to think it's really important, I think, to think about energy in this context, because while China is stockpiling a lot of crude, they're not consuming as much crude as they say they are, and that's really important. It's also really important to think about. They say on paper they're consuming 17 million barrels a day of crude. That's really held up oil prices for the last several years. The IEA and everyone still says that's what they're consuming. They're clearly not. They're probably consuming 15, so they're stockpiling 1 to 2 million barrels a day. That's a pretty big deal because when we think about Russia, and we think about these refineries that are getting hit, and up to 20% of China's refinery capacity is getting hit by Ukrainian drones and Ukrainian strikes. So when they take those on and offline, and they repair those and everything, but you think about, people say, okay, oh well, their refiners are getting impacted. Should that push oil prices up, or should that push it down because they're not drawing that crude? I'm not too worried about Russian refined product and their need for it, especially in the war effort, because China has excess refining capacity. They actually have 18 million barrels a day, as much as we do now. And so they have excess refining capacity, so they can supplant that for Russia. So that's just important to think about. So all these themes, when we talk about China and energy and everything, I think we really have to appreciate that there's a lot of things going on under the hood, and energy is a massive, massive component to that. And it's a huge, huge driver to the ability for China to compete. And it also, all the stuff that I talk about might sound a little esoteric and a little out there. Also, it eventually comes back. It comes back to supply and demand funnels, and it comes back to weighing on actual oil prices and energy prices. All right, folks, with that, there's a pretty energy dense intro to a very forthcoming. What you're going to hear is a very, very heavy hitting podcast. I'm super, super proud of this, and really, really awesome to be on the stage with Haley Mitchell. So within this conversation and podcast, you are going to hear everything from the state of oil, where oil prices are at. Ironically, they are literally back up to the exact same prices we were on September 17th, which was about $60 a barrel. So you're going to hear a lot about the state of oil, where oil prices are at, why they should be there, what to think about in terms of risk for business, how to think about oil prices and risk going forward, a lot on Russia and Ukraine, a lot on China, the state of the economy, what's going on with electricity prices. So soup to nuts, we get into it. We also talk about the Fed and interest rates and inflation. So we cover the gauntlet, and we do it in a pretty nice fashion to where we're not rushing through anything. So really, really proud of this. Can't wait for you guys to listen and hear the feedback from this. But lastly, I just want to say, we also have, thinking about this, think about next week, and at the end of this month, we have the Fed meeting. We have a CPI report that's supposed to come out this week. So we are lacking some government data, including the unemployment report, because we are 22 days into a government shutdown. Okay. So it's very interesting that the way the stock market is kind of held up, despite the fact that we have this government shutdown, and we've got all kinds of things brewing and so much under the surface. And so, we didn't even get a chance to talk about all the stuff going on within Venezuela, and the fact that we're targeting ships, and we're targeting drug ships. So there's a lot going on there. And so I simply think there's way more geopolitical risk in the market that is supportive of oil prices that's not being baked in. And I'm not saying we don't have a lot of crude on the water and we don't have a lot of supply. We absolutely do. And you're going to hear that in that conversation. But we have way more geopolitical risk that's not being deeply understood by the market, and certainly not being deeply understood by traders. And so with that, folks, thank you so much for listening. I just want to give a shout out that my sister helped me make this awesome shirt. I am definitely sporting a lot of PetroNerds gear here, but my sister Angela helped me make this. So huge thank you to her. Thank you guys so much for listening, and can't wait to talk to you soon. All right, folks. So I just want to add here before I close as well, well is that some of the reviews I've been getting, I mean, I've been on the road a lot and speaking. And yesterday when I was speaking, somebody came up to me and they told me they listened to the podcast, a young woman. And, she said to me something like, I have to, she says, sometimes I like to listen to it, when I'm not, too busy at work. And she says, then I have to stop it and realize I really have to pay attention. And someone else commented on LinkedIn and said, this is appointment listing. Like, this is a must listen to. And these are, I really appreciate this, but I want to explain this to people is that when you guys are listening to this, and this is what clients get is a much, much deeper dive of what you hear in these podcasts, right? I try to give a lot to the market, right? And I try to talk to folks and get this information into the market. It's really important. But clients, when you're paying me, we're getting a lot deeper, right? We're going through all the slides and all the numbers, and we're spending a couple hours at a time deep diving. And I'm also available to my clients for them to just call or text at any time to have this feedback loop. So that's what you get when you work with PetroNerds. But also, if you guys are thinking of sponsoring or partnering with someone or sponsoring the podcast, a partnership with PetroNerds is unique because people are not just listening to the podcast, they are paying attention. And I think that's really important. And that's how I differentiate myself and the business. And clearly, I think you can realize that when I talk, I'm deeply passionate about this and I care about it a lot. So if you are interested, please reach out at the PetroNerds website, petronerds.com, on the contact us page. I would greatly appreciate it. Thank you, folks.
All right, I think we are ready to get started. Incredibly happy to have Trisha Curtis here with PetroNerds LLC to talk to us. We have an action-packed, we only have an hour, so there's gonna be a lot of content, a lot of information shared. Don't worry, you'll have access to content later. So yeah, without further ado, Trisha Curtis, let's go ahead and dive in.
Hi guys, happy to be here.
All right, so let's start high level and just kind of talk about oil and gas prices, where are we at, and let's do a deep dive.
Yeah, so we have an hour, and I thought that your previous presentations teed this up really well. I was surprised no one raised their hand and started asking about peak shale or started debating, reserves and sticks on the map and sticks in the ground, because those are really good questions. But yeah, I would say starting with just, the biggest questions I get, probably things you guys are most interested in is, where are oil prices? Are they where they should be? And what the hell is happening with oil prices? Because actually, as you were seeing in the previous presentations, they're not that bad. Actually, today we're 64 and change. We are about ready to have a Fed rate decision, or maybe we just had it and I missed it. I think we're about ready to have it, and it looks like the Fed's gonna lower interest rates about 25 basis points, so that's gonna impact the market. But we're looking at 64 and change. We were at 65 last night, which is a really nice move up. I've never seen, I think the pessimism and sentiment in the market and the lack of certainty by particularly E&Ps and like the direction of travel, I always explain to people, whether you're on the service side or in any part of the business, that we don't have conviction in the market. We don't have a lot of people who are looking at everything and just looking at oil prices and feeling super comfortable and just saying, let's go. However, what we are seeing from a production standpoint and a productivity standpoint, and actually what we just seen in the rig count and frac fleet, is that we're seeing some stabilization. So E&Ps say something, and they seem to be doing something else. And certainly from a production standpoint, the U.S. is not ceding market share to OPEC. And I think that's smart. I really do not think it's the smartest move in the world to be thinking that the U.S. should be ceding market share to OPEC. And that is something that we heard earlier in the year when we started hearing and feeling all this angst on oil prices, was that the U.S. needed to drop rigs, drop frac fleets, drop production, and let oil prices go up. And the problem with that is there's no guarantee that you do all that and then oil prices go up, because you have plenty of folks within OPEC who are just increasing output, and that's what they've actually done. So this 64 and change, there's a lot of drivers from that. And I spoke a few weeks ago at the end of August in Midland for the first Whitley Penn conference, and holy moly, the world has changed a lot in 2 weeks. I mean, we're looking at, just the other day we had $61 a barrel, last night we had $65 a barrel, and several things happened over the past couple of weeks. So the geopolitical backdrop, which I think is worth getting into a little bit, is that, so I was in Washington, D.C. the week after the Midland thing, and there was 2 flyovers of fighter jet flyovers, which were super cool. I was on a rooftop, I got to see those were super cool to see. But the Polish Prime Minister was in the White House. And so everyone said that Trump wanted to show off these fighter jets to the Polish Prime Minister. But actually, what he wanted to do was show China and Russia that he also had some fighter jets, because China was hosting their military parade, and they had Kim Jong-un from North Korea there, and they had Putin there, and they had just hosted the Shanghai Cooperation Organization meeting, also called the SCO, the weekend prior, and they had Narendra Modi from India also there. So all these countries are there, and they're all hanging out, and they're all chumming out with China, and so that's just kind of happening on the backdrop. And then, so that's happened. We have these fighter jet flyovers. And then in the past week, we have had Russia put 19 drones entered Polish airspace. And so at first glance, people would have thought, okay, maybe some of those were accidents. But no, they weren't, because if you look at actually where they were, they're pretty deep into Polish airspace and deep within the country, which means they were completely intentional. So what Russia was doing was actually testing to see how far they could push NATO. What would be the response? And the response thus far has been Article 4, which is not Article 5. Article 4 is we're going to get together and talk about what we do. Article 5 is we do something. So that happened, and then we just had an incursion of Russian drones into Romanian airspace as well. This just happened. So all that's sort of heating up, and I have said, and I tell people this a lot, but I am not your typical bull on oil prices. You will never hear me being like, yeah, we're going to 85, baby, and we're staying there because the market's just going to go, go, go. It's just really hard for me to get there because we have so much oil in the US and we have so much oil globally. Definitely cases where we can get there. However, we have not been accurately priced most of the year. We should be much, much closer to $70 a barrel the entire year, simply because we have so much geopolitical risk in the market. And so that what's happened in the past few days is that basically we have no geopolitical risk priced in, and so it's coming back a little bit. But we've also had, on the Russia front, Russia's going into actually utilizing natural gas pipelines where they're sending their people in them and going around the front of Ukraine. So very, very unique moves. That's the third time they've actually done it in Ukraine. So Russia's amping up the war. They're not dialing it down. And then you've seen Ukraine use drones to actually attack Russian refineries. And so that was one of the biggest moves that you saw in the past couple of days, was that they hit a 400,000 barrel a day refinery, and you can bet your ass that Ukraine is going to continue to keep going down that route as long as Russia is not coming to the table. It doesn't seem like Russia's coming to the table. Trump has said out loud a couple days ago, he said essentially, we are willing to sanction Russia if the rest of Europe is willing to sanction them too. And the problem is that Europe is still taking Russian crude right now. They're actually still taking liquefied natural gas as well. So Europe has to get serious about not buying this stuff. And then that gets us into, which I'm sure we'll get into, tariffs and India, but both India and Russia, or both India and China are buying a massive amount of crude oil from Russia. And that's where they're getting most of their funding. So essentially exports from Russia have stayed about flat since they started this war in Ukraine. And so they're still getting this revenue. Yes, their crude's at a discount, but not by much. We're talking $4 or $5. So India and China are getting a little bit of a discount, but they're buying all this crude oil. And most importantly, China's not buying just the crude oil, they're buying grain, they're buying coal, they're sending Russia drones, they're sending them tech, they're sending them ammunition, they're sending them everything you can possibly think of. So if there's one entity in all this that does not want this war to end, it is absolutely China. And so it's just not something you hear addressed nearly as much in the media. So that's just one snippet on the geopolitical side that I think we have a lot of hotness on geopolitical angst and risk that is just starting to, you're seeing a little bit price into oil right now.
So let's bring that to domestic and what that kind of means for the people in this room and how that's going to impact, supply and demand here.
Yeah, so what's happened to date is that, as I mentioned, that the supply and demand side is that, oil prices have been low. That's partly because we have, we're appropriately pricing oil prices, as I mentioned, but we have a lot of supply. So very simplistically, we are producing 13.6 million barrels per day, more than any country on earth ever. Every time we notch that number up, we just break our own record and break global records in oil production. So it's a very impressive figure. Probably not enough credence is paid attention to the fact that, just sit and think about that for a minute. 13.6 million barrels a day. We're almost at 14 million barrels per day. Nobody thought we would ever get there. Even people within the industry thought it was a pretty far cry that would get there. Now, we need to be thinking about, so what does that mean? The economic implications of that are huge because our economy is now running on that. And so from a production standpoint, from an export standpoint, there's a lot of things going on. But it's really important to think about, so we have all the supply in the US, we have all the supply globally, and what this really means for producers is that, okay, well, what does this look like? now you heard in the previous presentations that folks are absolutely looking for, you definitely hear a lot of interest that folks are looking for more core acreage. I think people are looking for acreage, period, right? And you're not seeing enough of, you're not seeing enough of the companies like the big boys actually peeling off their assets. Although we did just see a couple days ago, Exxon sold their Wilson Basin assets to Cord for $550 million. Really, really good move by Cord, and really impressive. Like, that's a needle mover. That's a needle mover for North Dakota. That's a needle mover for the Wilson Basin, and that's great because that means that a pure Bakken player just got these assets and they're going to run with them. And if you followed Cord and you looked at those lateral lengths, holy crap, we're talking about 17,000 feet. We're talking about U-turns. I mean, they're really, really pushing this. So when I hear about the lateral lengths, I often chart it and I show it. Is that average lateral length and rig count? And there's just one direction, rig count down, lateral length up. And so that's been your biggest driver, is that incremental efficiencies. Everybody thinks it's, one little thing, but it adds up collectively, all these little things companies are doing. And I think it's really important to think about, if you think direction of travel, where are we going? No one has a good crystal ball for oil prices. I can tell you that we are absolutely not appropriately priced now. Like, prices should be higher. They should probably be closer to 70. If we were closer to 70, everyone would probably feel a lot better about the business. That doesn't mean there's certainty, but they're a little more comfortable with that pricing. And actually, I think the economy would be okay at 70, and I think 70 is kind of a sweet spot for the Trump administration. They won't say that out loud, but it could be a sweet spot in terms of the industry as well, in terms of growing or maintaining output. But all that means is that we have to everybody's kind of got to understand all these fundamentals. There's a lot. I mean, I live, eat, and breathe this, and it's not easy. I mean, there's so many things impacting the economy, and so many things impacting oil prices, and so many things impacting production. And I would say this industry, there's a lot of noise about peak shale, and can we keep going, and no, our lateral lengths can't grow, and I don't think we've talked anywhere near on, sheer efficiencies. We made some massive gains in the past few years by drilling faster, drilling longer. Sure. Can you drill any faster? Maybe not. But honestly, when you start looking at companies in the Delaware, those lateral lengths are not that long. You're starting to see significant moves by Exxon, looking at EOG and some others. But then you think about Haynesville, where you just heard that it is really hot. It's very thermally mature. It's awesome because you get these monster wells, but you have to be able to know what you're doing there. And so, but when you hear from the frac side, and I think it's super, super important to pay attention to the service sector, because they tell you about what's going on. And they told us in the past quarter that there was white space on the calendar. Basically, they told us, hey, things are dropping off in the second half. However, they're also telling us that production and productivity is being maintained, right? And that's really, really significant. Is that, so when you hear that, and then you actually look at the data, and you look at the numbers, you look at the frac fleet, you look at how many rigs we have, and then you look at the production numbers, everybody thought we would not be at 13.6 million barrels a day in June, and we are. So we're clearly not ceding market share, and we're maintaining productivity. So there's a lot of things going on under the hood.
Yeah, so let's focus on risks. So we've kind of hinted at some with tariffs and things like that. Let's focus on the risk. What is the risk that you see? What currently in the market?
Okay, so there's always risk that prices go down. Absolutely. Actually, I think there's a lot of risk that you don't lean in. So companies that have leaned out and are kind of waiting and seeing, you have to be careful with that, because everybody's got investors of some form, right? Whether it's the bank, whether it's their, whether it's a wealthy person that are investing in them, everybody's got an investor. And if you are in oil and gas, I encourage you to look into the mirror in the morning and realize that you are in oil and gas, and you're probably going to be in oil and gas for the next couple of years. And if you're not comfortable with that, then you need to get out. But as long as you're comfortable with, in 3 years I'll be in oil and gas, they should probably think about where you're putting the drill bit and why you're waiting. And so if you're not making money, that's one thing. But we have had opportunities to hedge, and we're going to continue to have opportunities to hedge as we flirt back up to 70. And so there's a lot of opportunities there. So I do think there's some risk that companies are not, we don't, like you heard before, we're not seeing these transactions. They're more of a trickle. So I wonder if some folks are going to be a little, worried that they had opportunities to sell. We certainly are seeing midstream very hot right now, where people are spinning off their midstream assets and selling that. So there's definitely risk within the economy. I think when it comes to tariffs, we're absolutely seeing some issues on components. Whether it's more, I've heard it from the service sector and others, certain components getting tangled up in this. You heard Diamondback in May talk about tariffs within their letter, and I think a little bit within the earnings call as well. not everyone feels that same way, that the casing costs or their drilling, it's a fraction of their drilling costs. So I'm not sure every company, actually I know every company is not necessarily saying, okay, tariffs are up on steel and therefore my casing costs went up 5% and I'm going to drop that. That's more of a justification, not a reason they're doing something. But that's still real, right? And I do want to highlight that $65 oil today is not the same as $65 oil was 5 years ago because of overall inflation. And I hear that over and over again by folks within the industry who are producing oil is the level of inflation that they've seen, and that includes tariffs and components and all kinds of things, impact their business. But I really do think that, so understanding risk, understanding volatility, understanding uncertainty, understanding the macro, and having a vantage point, probably the biggest risk is that people don't understand where they're at and where they're going and have a clear roadmap. You don't have to have the crystal ball to say, here's where oil price is going to be. You have to have the confidence to say, here's where we will be as a company in these different scenarios of higher, lower, whatever it is. And I think and that's what I do as a business, is obviously help people with this. But once you do that, the risk and the fear factor goes way, way down. And you get way more comfortable actually executing a business. And so the problem is when everybody gets crazy and prices drop a little bit and you get the tariff craze and April 2nd, and then everybody in the oil and gas industry getting really grumpy and losing their minds, that's just not helpful, right? That slowdown and that we don't know what we're doing, that doesn't really, you cause uncertainty for the service companies. The service companies are getting pretty beaten up right now where they're not having any margins. That can't last, right? And so I think this industry should have learned the lesson a long time ago, is that you heard these numbers before from the banks, is that the profitability is great, right? We're not burning cash. We have really good capital discipline. The industry is making money. Now the thing is execution with that. But if you think that a pullback and hurting the service sector and getting rid of all your private operators, that is not good. That is not what we want to see in the business. So I do think there's a big risk, is that if we were going down this track of this massive M&A where, and no offense to the publics, but because they're big, nice companies, but Chevron, Oxy, Exxon, if they own everything, that's a problem. Because that means that we don't have actual little companies doing things. It's the smaller companies that de-risk, that step out. Those two presentations conflict a little bit, which was fantastic. Is it saying, hey, everybody's looking for core, and the other one was saying we're stepping out a little bit. And actually, I show that map a lot of the public-private rig count, and that's where you see the privates, is they do step out. And so I think real risk is that not understanding the market, not actually taking appropriate risk in a 60-something oil price, realizing that we are not in that bad of an oil price range, and not hedging. I think that if you're thinking, okay, prices are going to go up and you're afraid to hedge at 65, if 65 is going to save your business and save your employees and keep you comfortable for the year, I've told people that at the beginning of this year, 2025 is not going to be an amazing year, but it's not going to be a horrible year. It is absolutely not going to be the worst year ever. And we haven't seen 50s. People talk about 50s, but we have not actually, we flirted with them for a second, but we haven't seen them. And that's because you have so many of these geopolitical risk factors and basics of supply and demand. And then the other big risk that you're probably all wanting to know is on the economy, on that downside, that slipping and rising unemployment. And this is where $60 oil is super, super important actually it has done a lot of heavy lifting for this economy. And I can't really underscore or underline enough, we probably don't appreciate from a global economy the role of this 13.6 million barrels a day, the fact that we're not importing as much crude oil, but we're exporting 4 million barrels a day, we're exporting a lot of LNG, so we have massive economic benefits to this. But that 60 barrels, $60 to $65 a barrel, hugely important in a softish economy. And I do call this a softish economy. We do not have job growth ripping. We don't have the global economy ripping and oil demand ripping with it. So oil demand is not rising, and so when we have all this supply, it's keeping prices muted. But that muting of prices is so helpful to the consumer. And so it's done all this heavy lifting to the economy, and it's really helping it's keeping jet fuel demand up, right? It's keeping diesel demand okay. It's keeping everything kind of okay. And so it's being very supportive. So if we do see a price spike, like right now, if we saw $85, $90 oil, it would be bad. It would not be good. And that's very interesting to actually look at the stock market and see stock market goes up when oil prices go down. And so it shouldn't be like that, right? We have a disconnect where there's something happening and you clearly see some weakness, right? You can't have $61 oil and a ripping stock market in terms of what is driving that growth. But the stock market was not happy in June when we saw $75 oil, when we had Israel striking
Iran and then us striking Iran. So we had that price spike. Again, that was a moment to hedge. That was going to be short-lived. We started $80 a barrel this year. So I think not hedging and then not understanding sort of where we're at and that sort of dropping activity. There's several risks in the market, but the health of the economy and sort of understanding where we're at from price standpoints, that's a really, really big one that we need to appreciate as an industry. And I think it's super, super supportive for demand. So the big risk is that we have a price spike and then demand collapses. We are really basically guaranteeing very healthy long-term demand right now with 60-ish something oil prices.
So can you talk to us a little bit more about the Fed and the path of interest rates and inflation and what that means for our economy?
Yeah, so we are, unless there was some big move and we have a surprise of a 50 basis point rate cut, we're looking at a 25 basis point rate cut today, and everyone's asking, or everyone's questioning, is it going to be a dovish cut or a hawkish cut? And are they going to cut and basically signal that there's future cuts, or are they going to cut and sort of say they're going to wait and see? The big problem is that we've had so much inflation that's built up, and I mean, I cannot underline it enough or emphasize it enough. If you listen to the podcast, if you're a client of mine, you hear it a lot. And I constantly show the charts of inflation and interest rates. The Fed did not do the job on raising interest rates high enough in the first place. So they didn't cool off inflation when they had the opportunity to cool off inflation. You have inflation usually when your economy is ripping, but you have too hot of inflation. They could have jacked up interest rates. People could have got amazing rates on interest, and they would have incentivized to actually save their money and get interest as opposed to spend it. And that's what you do when you raise interest rates. That's not what happened, right? They barely raised interest rates, and then they pulled back last year 100 basis points. And so now we're sitting at this place where we've seen inflation notch up, and people say, oh yeah, it's like 3%. Well, it's not 3% at the grocery store, okay? It is 15, 20, 30% on certain items. It is massive at the grocery store. And tariffs, the tariffs are very interesting because we're not seeing massive price spikes, but at the same time, you've also seen a lot of people buying a bunch of stuff and holding it. Walmart can't really afford to pass on massive price spikes to their consumers. That they're largely grocery, but certain things where they do have a big price spike, you might see pullbacks. So you have a little bit of tariffs where it's super interesting is that, everybody complained about it, and they complained that we have a big deficit, but the tariffs we're bringing in hundreds of billions of dollars in revenue from tariffs. We haven't had a massive price spike, but essentially what we continue to see is a continued rate of inflation. And so that erodes the purchasing power of the consumer. And so when people say, okay, retail sales are hanging in there. Yeah, they're hanging in there, but my retail sales are not based on how many shirts I bought. They're based on the cost of that shirt. And so I can keep retail sales up if I keep having inflation. And I think that just discounts, a large people under, half the economy that is living paycheck to paycheck and getting their ass kicked by inflation. And everybody thinks, well, we lower interest rates, we help them. No, you don't help them if you lower interest rates. If they're living on credit cards, that's a problem. I don't want them living on credit cards. I want them paying their bills. So this thinking lowering interest rates is going to help it. We're going to goose inflation because housing is going to creep up back a little bit. We didn't get housing cooled off. So there's big problems with that. Now, everybody in business wants it. The stock market wants it because they can borrow easier. Well, we're not tight. Credit, we are not in anywhere tight. We have a pretty loose monetary system right now. People can access money. They can get it pretty easily. So the idea that we're tight, I think, is fiction. The idea that we've cooled inflation is fiction. But the Fed has sort of signaled, and they're in this, so they're going 25 basis points, and that's what's going to happen. I think last time, I think your colleague asked in Midland, what was the implication for the oil and gas business? I mean, it can help if you have a little bit lower on borrowing costs. But the problem is that, and we are seeing some interesting where the 10-year yield has come down. So the 10-year yield is where you tracks with the 30-year mortgage. So if you're watching that 10-year yield, it has really come down. We're looking at fours. If the Fed literally right now is talking and they're saying, hey, we going 25 basis point, but we're signaling we're definitely going more, you could see that 10-year yield go down into the threes, which is going to impact mortgage rates, you're already seeing people refinance, and you're already seeing that get busy. And so that could hold things up, but it could also propel a little bit more inflation there. So there's a lot of different angles, and I think we have to be a little bit careful that we're goosing the system a little bit, and we haven't dealt with the underlying inflation, and we have a lot of moving parts. That all being said, it's like musical chairs, and the music's still going, and everyone's got a job. But when that music stops and people start losing their jobs, that's the other piece of what the Fed doesn't want, or they said they didn't want last fall, and that's why they started lowering interest rates. There's not a direct correlation between lowering interest rates and fixing the job problem. Like, that just doesn't, there's not a one-to-one correlation of we lower interest rates and people don't lay people off. It's not. I can lower interest rates and people will buy houses. That's a one-to-one correlation, but it doesn't have anything to do with the necessarily direct with the layoffs.
So we talked about the U.S. economy quite a bit. Let's expand that to global economy, China's economy, and so forth, and how that's going to impact demand.
I told her she had to push on China because I like talking about China. If anyone knows.
I also listen to your podcast a lot, and I love listening to you talk about China.
So China's a big one. So yeah, the global economy it's not amazing. That's why I say it's not collapsing, but it's not amazing. So I mean, I've been telling clients for years that, think about where oil prices were last year. Okay, that was a much more kind of realistic where we were. And oil prices last year were telling you that demand was not ripping. You were backsliding toward the lower 60s or the high 60s and $70 oil prices at the end of last year. That's basically where we were. That was supply and demand fundamentals. Now we have all the supply that OPEC has brought on, and we can maybe dive into that a little bit more too of what's happening with Saudi and OPEC. But the global economy is not rip roaring, and so you have to have a rip roaring economy because basically you have to drive. Where you drive it. It's gasoline demand and it's diesel. So what's happening in China is that on paper, they're consuming 17 million barrels per day. So that's their demand. And so since COVID, it basically looks like this, where it's gone from 14 million barrels a day to 17. That's insane. Their economy has not grown to support a 3 million barrel a day, 4 million barrel growth. It's not real. So they're stockpiling a lot of that. And so that's actually all this supply, this opaqueness, when we're dealing with Iran, when we're dealing with China, when we're dealing with Iraq, actually Iraq is included because Iran is heavily influencing Iraq, when we're dealing with Russia, when we're dealing with North Korea, start getting a really messy picture of oil, where you can get Iran sending barrels into China. I don't know if you guys remember, but in June when we were striking Iran and Israel was striking Iran, Iran was like selling barrels out of China, meaning that they had storage in China. Which was all kinds of confusing, which means, people aren't, when crude oil goes into China, it gets kind of lost. And so when we talk about supply and demand and trying to get the numbers right, it gets really messy. So China becomes this very opaque, messy box that's already opaque. So we're probably stockpiling anywhere between 1 to 2 million barrels a day in China, which means that demand on paper is getting pulled in, but it's not getting consumed. And that means something, because it means that, they have more refining capacity than we do actually now. They have over 18 million barrels a day, which should make people anxious and nervous of why they have that much crude oil if they're not using it or they're not growing. So they can refine a lot, they can put the products on the market, they could actually be sharing it with Russia. I'm not super worried about Russia's losing this 400,000 barrel a day refinery. It can definitely impact oil prices, but China can backstop that and give them diesel and jet fuel and whatever they need for this military effort. So that's a messiness, but the Chinese economy, simplistically put, it's a manufacturing, government-driven economy. And we can talk about power and AI, but when I think about the way we talk about AI and the way we get all excited and talk about nat gas and everything, it's a very, very different story in China. And so the reason I'm linking this back on the economy is that you're seeing the property sector decline, just continually decline. So you can just liken simplistically the property sector to the consumer economy. People like you. That they're not driving the economy. You're having out and out deflation in China. You have very low interest rates. You can't incentivize people to spend. They're just saving. Well, all that savings in the bank is then accessible by the government, so the government can do whatever they want. Government has massive, massive debt. Way, way more than we have for debt. Massive debt, but it doesn't really matter because that's China. They just hide the ball. They just move stuff around. But it does matter in terms of when we have GDP growth, we build something and it becomes a part of the economy and it gives us economic growth. If you build a bridge and no one drives on it, is it GDP growth? I mean, if it's not contributing to the economy. Yeah, it might be in that first, I built it, but then what? And so right now what we're seeing with China is they're just doubling down on building everything. And so it's export-led growth, but it's also about putting everyone else out of business. It's happened in solar panels, it's happened in batteries, it's happened in EVs. They just decimate the competition. We don't really need those EVs and solar panels, but anyways, they decimate the competition so no one can enter. That we definitely see this in rare earths with all the refining capacity. So there's big problems within that sector. But when it comes to AI and when it comes to like them building this up, we just heard today that they banned NVIDIA chips, that China is not taking any NVIDIA chips. That's a big one for NVIDIA because NVIDIA was banking on them taking these chips. The Trump administration said that they were getting a cut of these H20s, and China says, I don't want them. Well, they don't want them because they want to build their own stack, and they want to do this. But China is not building AI because they want top, Tom Cruise videos with Nicole Kidman that you can have at home and you can just watch yourself with you in them. They're building them for robotics. They're building them for the military. They're building them for their own competition to leverage themselves as a nation, not for their consumers and their behavior. So there's a very different thing. And so we are struggling. I think the economists are stock market, CNBC, Bloomberg, FT, Wall Street Journal. They're abysmal at actually telling the real story of what's going on in China and what economically is happening, and then marrying that up with crude oil demand. It's a very unique thing that's happening. So not to fear you all with that, but I mean, it's really serious in terms of when it comes into supply and demand balances and what's actually happening. That it gets really complicated. Europe does not look great. They are, kind of just declining because their electricity prices are so damn high. They can't build anything. You can't build anything if you have very high electricity prices. I mean, very simplistically put, if your electricity prices go like this, your manufacturing goes down. And so it's something we have to take very seriously as a nation, is that our electricity prices are just through the roof. And that's because we're forcing wind and solar into the grid and electricity prices are rising. But in Europe, their economy is just very slow. They're getting decimated by Chinese competition, and they just can't make anything. And so really important when we think about their commitments to NATO, and Trump's in the UK right now, and I'm certain they're having some serious conversations on China, some serious conversations on AI and all kinds of stuff. But they're out of the AI race. Like, they're barely even in it because their electricity is so expensive that they can't actually do the artificial intelligence and the LM models and these hyperscaling and stacks because it's too damn expensive. But really importantly is that all these, you saw a pivot in the stock market where everybody said, let's invest in Germany and let's invest in France and let's go invest in these countries that are going to increase their fiscal spending and spend on military. Well, their economies are not that big, right? Like, Germany is the size of Apple, like the whole damn economy, the whole stock market. So you don't have the depth and breadth, and the liquidity to actually invest in it that way. And then to think that they could actually hit their NATO spending, they will have to change their energy policies dramatically to hit their NATO spending, because they have to actually, unless they're going to buy all of it from us, they're going to actually have to make some of this stuff. And so this does get back to the fact that we have been sending, Ukraine ammunition, a ton of ammunition, and we have now drained our stockpiles, and somebody, us and the rest of the world, has to replenish these stockpiles. It takes power generation to make that ammunition. And so we have to be, you have to have the power generation. France actually was unable to, we started attacking the Houthis because France didn't actually have the ammunition because they didn't have the power generation to build the ammunition to attack the Houthis. I mean, these are really serious things, and so, and we're in the fringes of war, where we're actually in war, but we're not talking about it publicly. But when you think about actual out-and-out conflict, heaven forbid we get into one, that it will all be about power generation. And that's why it's so important to get it right.
So speaking on the power generation, so we've talked about AI and we've talked about China, but let's bring it to domestically and what you're seeing with AI currently in the United States and where we're going with that with power generation here.
Yeah, so it's a really sexy topic. Everybody loves to talk about it. I imagine here in Fort Worth and around Dallas, you have a lot of people, talking about it, especially on the natural gas side. Because everybody is very bullish on nat gas now. And interestingly enough, I was just looking at EIA. They, in their September energy outlook, they're showing a pretty nice spike in natural gas prices next year, and a pretty big decline actually in oil prices. So very interesting for 2026. But they're basing that on all this, essentially LNG demand or LNG exports. And there's a trickiness right now, is that we are basically flat year over year for LNG exports out of the U.S. Actually flat globally. We had 53 BCF a day that was on the water of LNG moving, of a 400 billion cubic feet per day global market. 53 BCF a day was 2023, and 53 BCF a day was 2024. So it didn't grow from 2023 to 2024. So I was thinking that EIA was going to show that this was a power demand bump. but they're not really showing that. They're showing more of it. They're showing a little bit, but they're showing more of it actually in LNG. And so that would mean that we would have to get a lot of ships built to start moving this LNG. And I'm not saying we won't. I'm not saying that the demand, there's a long-term real good story on exporting more LNG. But we have to get the ships built. There has to be a lot of moving parts there. But when it comes to power, I was just in Houston and I hosted Ron Gusick with Liberty, Andrew Navanti he's the CEO of Calpine, and they're the largest natural gas, basically, putting natural gas into the grid. They have a bunch of combined cycle facilities. And so largest natural gas provider into the grid in the US, and then the CEO of Rockcliffe Energy. And it was really interesting because we talked about this, and so we spent a lot of time talking about power generation and AI last week in Houston. And I will say my single biggest takeaway in studying this is that we've overestimated probably the demand for nat gas. And it's not that I'm not super bullish on nat gas, but I'm concerned when I talk about electricity with people, especially in Texas, that there's not a recognition that your power purchase agreements, people are still building so much wind and solar, and it's crap. It's horrible forms of energy, and it directly increases electricity prices. But people are building it. And that is because people are getting permits, and and you can do it in Texas. You can get the access permits, you can get the land, you can do it. And lots of people are getting wealthy. A few people at the top are getting wealthy. No one else is. This is not a pass-through. This is actually screwing the consumer over left, right, and center. So we have this big problem, and that to me, every time I hear this and see this, and I actually see also in EIA, their projections for solar wind growth, is that nat gas is not getting enough share of that pie. And that's because across the country, these power purchase agreements are incentivizing so-called cheap wind and solar to get into the grid. But once it gets into the grid, the price gets passed on to the consumer and it rises exponentially. And that is because, not just because it's intermittent and the sun only shines when the sun is, or the solar only works when the sun is shining, and the wind only works when the wind's blowing. It is because it's not very dispatchable, right? It's not, you have to build a lot of transmission. And again, in Texas, you probably can do that a lot easier than you can do that in Colorado or other places in the country. But we are not building things well in this country, and you need a crap ton of transmission built to actually have wind and solar. And so it's a really inefficient form of energy. So wind power is 1,000 times, natural gas power is 1,000 times more energy dense and more power, like the power density of wind is 1,000 times less that of natural gas. 1,000 times. We are not even on the same comparison for scale. And yet we're forcing these into our grids because China is subsidizing them and making them super, super cheap. So we buy them and then we put them into the grid. And then we end up with these very escalating costs. And so now, we are as a nation, we're at 19 cents a kilowatt hour, but in the cities we're, places like California, it's 45 cents a kilowatt hour in Los Angeles, which is the same price, by the way, as it is in Germany. You can't build anything. People can't live off that because the average person can't. It's not competitive. And so it really hamstrings businesses. And so when I think about AI and nat gas, I start getting nervous is that we are not holistically thinking about this. And I know they are in DC. I know folks, like Chris Wright, the Secretary of Energy, they're thinking about this. But the problem is on a state level, a lot of this is state driven. We have crazy ESG things in Colorado. In Colorado, we have over 30% of the power generation comes from coal-fired power generation. Over 30%. So 1/3 of the grid is coal. By 2031, 1/3 of the power will be gone because they're getting rid of all coal-fired power generation. With no answer. Maybe it'll be geothermal, maybe it'll be nuclear, maybe it'll be this, but hello, it's happening right now. So there's no answer to it. And that's really problematic is that we've lost our minds, working on Colorado, dropping CO2 emissions. Colorado CO2 emissions are 0.2% of global CO2 emissions. So not a lick in the damn bucket of global CO2 emissions. So if this is about CO2 emissions, newsflash, you are not helping, okay? You're not doing anything. So really then if we set that aside and realize that China's CO2 emissions are literally like this, they're almost 14,000 million tons, and we are declining, we're less than 5,000 million tons, then really we have to start getting honest about prices and affordability, and honestly, efficiently, and with coal. And I'm gonna say something really outlandish here, is that I love coal. I think coal is awesome. It's super energy secure, it's super reliable, and it really, really helps natural gas. And it's really important that natural gas people understand this and understand electricity, because as we pulled out all this coal out of our grid, and we are, for the first time in the past few months, we actually have more wind and solar in the US grid than we have coal. And coal is that baseload power. So it's dispatchable, it's transmissible, I can easily move it. It's also super cheap, super, super cheap. And this is a problem, is that if we start seeing price spikes in natural gas, that's gonna be a problem. And you know who's gonna get blamed? It's not going to be wind and solar. It's not going to be Excel. It's not going to be utility companies. It's going to be this industry that's going to be blamed for natural gas price spikes. Also important is that the $3 an MCF, the $2 an MCF, that the Waha you heard that people barely make the break evens and they get rid of their gas, that's not getting passed along to the consumer now. The consumer is paying $15 to $23 an MCF for residential natural gas prices. It's highway robbery. It's disgusting. It has to be addressed. And so we already have that happening, and so you can bet your ass that Excel and everyone else is going to jack up those rates like crazy when they have a little bit of a price spike. And so it's really serious that if we're aggressively decommissioning that coal and we're adding that nat gas and we get a little bit of a price spike, that coal has been there to offset, it's enabled all the benefits we've had of natural gas is that you can use it to offset any of those price spikes. It makes natural gas in the grid awesome. And so if you get rid of all that coal and then you add that natural gas and then you have all this wind and solar, you have a recipe for disaster. Not just power outages and stuff, but price spikes. And so we can't really afford to have that. And so if I haven't, pulled this thread together of national security and talking about China and stuff, we've got to get the power generation system right and the cost right so that everyone can benefit. But really importantly and critical is to win on AI, you need power generation. You need cheap and abundant power generation. China has that in coal because they have 10,000 terawatt hours, or a third of the world's power generation in China. So they can throw everything in the kitchen sink at this. And we're sitting here, figuring out, these power purchase agreements and shoving wind and solar and having jacked up electricity prices and people not being able to pay their utility bills. And we're the largest producer of natural gas in the entire world. So it's a joke. It's an absolute travesty and joke that we can't get this right. And it's really, really serious. So when you talk about risk, power generation, electricity prices, and access to affordable, reliable energy is probably one of the most number one for economic and national security.
So speaking on the national security, I've heard you talk about this a lot, and with China, and just focusing on their stockpiling of between all their energy sources. Really, will you dig in on that a little bit more and
yeah,
understand?
and I don't know how your guys' interest level on this. It's but they are stockpiling a lot. So I think you can think about a little bit too in terms of like how you think about that. The trade with Russia is really significant. So when I say like China doesn't want this war to end, they really don't want this war to end because it's keeping us very focused on Ukraine and everyone kind of focused on Europe as opposed to thinking about China doing nefarious things in the waters. And so that stockpiling, that's kind of a Chinese MO. They've always done that, right? They always stockpile from Mao to Deng Xiaoping to every leader in China. There's only actually been 5 in communist China. They've all, they would all love to stockpile. That doesn't mean they're going to war tomorrow, but it does mean that, it's very interesting when you start seeing the AI thing, like, hey, no NVIDIA chips, and you start seeing this doubling down on AI. Well, I know from studying China for years, they're not using AI again for those cat videos and the things we're thinking about it. And they're certainly not, it's not robotics, in homes. And I have to say this because in the last Whitley Penn thing, somebody had put up, a presenter was talking about AI and they put a Wall Street Journal thing up and it was like robots. And I was like, those robots that you see of thinking having a robot in your home, by the way, that's a pretty long way out of having a robot in your home. It's not about robots in your homes, right? It is literally about robots in the battlefield. And so it's a very different trajectory. And so if I was to say at any time that I'm more nervous about China, it's definitely now because they are clearly on a path of confrontation, right? Like that's what they're investing in is a confrontational path. And so the stockpiling, like, it is grain, it's coal, and that's why coal is so interesting to talk about is because, they are modern coal power. They are 21st century modern coal power. And people like, coal, whatever, poo-poo on coal. So they don't really think about what that means. That means that China has complete energy security for power generation. And China leans into power generation. They're disproportionately electricity tilted versus oil, right? They actually they consume more electricity now on a percentage basis than they did in 1980. So they consume less oil on a percentage basis now than they did in 1980. Just think about that for a second. It's a massive disconnect that I spend a lot of time thinking about on the national security side of what that means. I don't hear anybody in business or any CEO, and I've met a lot of executives that aren't thinking about this. It's tricky to translate it directly into how a CEO should think about it, but from a 5-year, 10-year risk standpoint, or just how you think even about commodities in the sector, it's meaningful. And I really think that we do need to start thinking about coal a lot differently, because coal is it's energy secure. And so when you think about China stockpiling it, it's a rock, you dig it up, You set it next to something, you can use it, you don't have to use it. And most importantly, and I love natural gas, absolutely love it, super bullish on natural gas. However, I have to, from the wellhead to the end user, there's a lot of infrastructure that has to happen. There's a lot of compression that has to happen. You know, I have liquids, I gotta fraction it, I gotta drop those liquids. And then when I liquefy it and I export it, I gotta turn it into a liquid, I gotta put it on a ship, I gotta send it over, then I gotta put it back into a gas, and I gotta send it to a house. And it's just, there's a lot of stuff going on with this. If you think of why China is doing this with coal, they don't have to do all this, right? They just burn the damn coal. And they still burn it in households on many occasions. So, I mean, it's much more simple. And so it also tells you a lot about China, that they don't care about the environment. They don't care about CO2 emissions. So stop fighting the battle on a state-by-state level of 0.2% in Colorado, because you're just killing yourself economically, and holistically as a country, we're hurting ourselves from a competitive standpoint. But, I mean, overall stockpiling, they're doing with everything. They do it with grain, they do it with oil, they do it with coal. And it really does impact, you know, it's probably a little harder for the oil and gas industry. I'm not harder, but in thinking about rare earths and thinking about the rest of the economy, these are starting to impact, you know, if rare earths are being throttled and your automakers can't buy them, well, your automakers are the ones that you put the gasoline and diesel into the trucks. So this does have a direct connection, and I don't think anyone had in their bingo cards, you know, 5 years ago that we were going to have rising utility prices and rising electricity prices and $60 oil. I don't think anyone projected that. They didn't think we would have high utility prices. They thought everybody would be driving an EV, and that we would have high oil prices, and that would drive people away from it. And we haven't had that. And that's because we're very, very good at producing oil. We're very good at producing oil at much lower prices than people realize. And that's what's happening right now globally. And we're just not, there are all these moving parts that we're putting together. And I would say, you know, you asked about risk too. Probably, you know, and I'm very fortunate. I love what I do, and I do a lot of work on the national security side. And when I get to work with executives and boards and C-suites and engineers and folks in the field, is that, you know, if you can pull this all together and you can start thinking about your business, you are 80 steps ahead of almost every other company, because they're just not doing this. And so I would say one of the biggest risks is that in trading oil, everybody's trading on gut and algorithms. They're not trading on all the stuff that we've just been talking about for 40 minutes. That's just not what they're doing. So we have a lot of embedded risk in the system because we don't have a lot of intelligence in the space.
So we have about 15 minutes left here. So I want to give some time also for you folks to ask questions, and feel free to raise your hands if anybody does have questions. But full well knowing that we only have 15 minutes left, I'm about to open a rabbit hole. You could probably spend a whole time. So we've talked about different commodities. We've talked about, you know, the efficiency of these commodities. Talk about your thoughts about nuclear and the future with nuclear.
This is a great question. I thought somebody might ask about it too. Is that, you know, I was actually here right after the election, or we're not here, sorry, Fort Worth. I was in Dallas. And I flew down to Dallas the day after the election, and I was speaking with a mineral company, and I did kind of soup to nuts of what was happening. And, you know, somebody had asked me about nuclear and the risk on natural gas, how it would impact natural gas. And, you know, nuclear, it's awesome in terms of like what it can do. We are not good on cost, right? The cost overruns of nuclear are massive. I'm not yet convinced that small modular reactors are going to fix the problem. You know, just because you make it smaller, maybe if you can get it done, one, you have to be able to build it. You have to be able to within a certain cost standpoint. But it could threaten, like if we do it, right? If we jump these hurdles, it could impact nat gas growth. And when I say some risks on nat gas before, I was mentioning is that I think we're just a little bit, we're thinking the BCF a day, the amount of BCFs to the actual power gen, our conversions just seem to be a little bit off. The hype on nat gas and the direct, like, this is what we're going to use might seem to be a little off. Not saying that we can't export that. But when it comes to nuclear, super exciting. And I would say as a military, we use it, we do a really good job with it. We just don't do it in the public domain, and that's because the cost overruns get so high, and because of the fear factor, and where do you build it. So building it on places where you have existing nuclear, that's great. Doing small modular reactors on places where you actually have nuclear stuff. And then actually the uranium, right? And you've heard Department of Energy and folks talking about this in the past couple of weeks, because Chris Wright's been in Europe, but like we need to we're still getting it from Russia. But we have a lot of spent fuel from our existing, you know, our actually existing nuclear stuff that we can actually utilize that, right? Because it's not, we can use it again. And so there's probably a lot of options there. And it really is it's a really good answer for power generation going forward. But if you were to tell me, like, is it going to happen in the next 5 years? Well, boy, and I say active Congress, like literally, we would have to have something really, really big to actually get something built. And then the cost standpoint, I think, has to be, we have to get that aligned. But if we just say, hey, costs don't matter, and this is a security thing, could we build it? Probably, and from certain military things, we probably should be. But in terms of like, is AI in the tech world, eventually they're gonna have to make money on AI. I have to see how they're going to make money. And so we can say, yes, they might want nuclear, but if that cost is so high, that stuff hasn't married up yet. So it's awesome, super exciting, it works, but no one's got the cost down, and we can't get the permits, so we can't build it.
Thank you. I'm going to open it up to the crowd. Does anybody have any questions?
Yep.
Do you have any concern with Venezuela and just the stuff that the U.S. is doing down there and how that could impact production from our hemisphere?
I have concern around Venezuelan production being really high. It's almost 1 million barrels a day right now. And that gets into, actually OPEC and the production increases. The Saudis in that last OPEC increase, that put them above 10 million barrels per day. And so I was looking at Venezuela, and they're about 1 million barrels a day. So we haven't really sanctioned any, we haven't implemented sanctions on anyone. And so Venezuela, yeah, I'm concerned in terms of Chinese influence in Latin America. That's a big one. I'm concerned about the government side. We could sanction that. We could get rid of that, and we could also hurt China in doing that. But I'm also concerned with some, the companies, like we have, Chevron in Venezuela, and we're allowing them to basically do stuff. We're continuing that. But we have to have a reality check. When we implement sanctions, we're not, like, the country is a bad actor. This isn't hard. We were talking about this at dinner last night, actually, and I was saying, like, if you're an upstream company or refining or whatever, and you've got assets in China, get out. Like, you don't have an excuse anymore. We know enough about China. It's like saying you're still in Russia. And Exxon flirting with the idea of going back to Russia is a joke. Like, that needs to end. And so when it comes to Venezuela, I think we just have to be very, very honest with ourselves of like how we're dealing with stuff. And I don't believe in giving, the industry a pass for just saying, well, we do oil business or whatever. No, they need to be held to account. So I am concerned about risk there. I'm concerned about too much production, and I'm just concerned they're not, that Chinese influence and access to it could be a big problem. Great question.
Any other questions?
Is Chris Wright and others in the administration as passionate about power costs?
Are they as passionate about power?
Yeah,
Power costs. So, Chris Wright is definitely passionate about it, and I've known him as a person, so he cares deeply. He started the Bettering Human Lives Foundation. He cares deeply about power thoughts. Something also I brought up at dinner last night was we often talk about access to energy abroad. We don't talk enough about power costs here and access to energy here. So I know he is passionate about it. I know he knows the data and the stats better than anyone in terms of people, dropping their utilities, getting cut off from the utilities. I think, and maybe it's, I just have to do it, is getting into DOE and explaining to them, hey, there's an easy win here with the oil and gas industry. Stop saying $50 oil. Let's talk to you about what $70 oil, how it can work in the economy, how it works for the industry. But let's talk about power. Let's talk about going after utility companies. So I have not yet heard that, and that makes people very uncomfortable when I say that. Let's go after utility companies. Absolutely, all day long, take them down. They're screwing the consumer over, and that's all ESG metrics, and that's all about wind and solar. And that's when I listen to an earnings call from Excel, and they talk about clean, and they don't talk about affordable, I am disgusted, because it's all about clean. Who voted for that? And the problem is they're working with the state of Colorado, and they're setting their regulations, and they're kind of colluding and doing it together, and the consumer's not getting represented at all. So I think there's an opening, absolutely, because they're publicly traded. They're publicly, they are regulated, but we have not put the pressure on them. So I know he's aware. I haven't heard this, and I was in DC, a couple weeks ago, and they said, what can we do? And I said, the next step is power. If you talk about lowering oil prices and helping the consumer, if you can start passing along the natural gas price savings on the consumer, that's huge. And I really do think as an industry, we need to get very, very loud about the fact that we get $3 an MCF, but the consumer is paying over 20. If that started changing, that's a massive gift to the consumer that could really, really help. It doesn't have to be much, but that would require utilities to stop jacking up the price spikes to pay for renewables and all those things. So they're aware, but I would really like to drive this home. Yeah?
I know you're business, but boiling it all this down, what are you seeing or what are you forecasting for natural gas, per MCF, like for the next 12 to 24 months?
I mean, that's a great question, and I'm sure that's what people get paid for, and they get it wrong. So I mean, so EIA has their projection out of a nice spike. We have to get substantial LNG exports or power gen demand growth. I'm talking several BCF a day. Right now we are at 15 BCF a day. We hang around 15 BCF a day for natural gas LNG exports. That has to grow to 5, 6, 7 BCF a day. I can tell you the national, all the things with that there's a real story to do that. We need the ships to do that. And it seems to me that we don't have enough LNG ships globally, and we haven't risen this number. So we need that. So I'm a little concerned about that number has to rise. And then we're very, very good at producing this. It's an extremely small molecule. When I listen to Liberty and I listen to companies talk about fracking in the Haynesville, and you hear about those wells crushing it, these are monster wells, monsters. And yes, they do it, and they do it well, and they execute. And so when you see a $4 nat gas price signal, you better hedge that, because it can go down because we're so good at producing it. So we are producing about 130 billion cubic feet per day gross withdrawals. And so I don't see that. It's one trajectory. It goes like this. And so I don't see that changing. And so yes, everyone's projecting this kind of price spike, but the problem is production flow goes with it. And so I'm just not sure that, I think 4 would be super healthy. That would be kind of this natural trajectory where we need to go. And I have to see the actual LNG growth. I have to start seeing 16 BCF a day, 17 BCF a day, 18 BCF a day, and I need to see it on the power side too. And if I start saying, okay, there's coal on the power side, but I decommissioned my coal and I added a bunch of wind and solar, I can have a problem. So I think we have this excitement and hype on the AI and the power side, and we don't have a real conversation on what each state is doing, the craziness, the ridiculous power purchase agreements, and the fact that we're shoving this wind and solar into the grid. And I think we have a lot of confusion and messiness there. So I'm not going to tell you to bank on it. I'm just going to tell you, if you're going to get greedy and you want 5 and you've got 4, I'd take 4.
I think we're going to be able to maintain production at around 13.4 to 13.6 million barrels a day in the mid to low 60-ish range.
We can. So we can. Will we maintain? I mean, we have produced. I'm surprised we didn't have more questions about this. We've produced so much more than people thought. I mean, with so many less rigs, with a declining rig count, with a declining frac fleet count, and it's because these lateral lengths are longer and because the productivity is held up. And I mean, 5 years ago, nobody thought we could do that. They thought, 1, the laterals can't get that long, and 2, no way the production at the tail of that well, no way the decline curve will hold up. And they've absolutely held up. So can the rock give it? 100% all day long. I can keep 13.6 million barrels a day with my eyes closed. But will I drop activity, and will I really slow down? I'm not yet seeing that I have to see completions drop off, and I look at this very closely with individual basins, individual operators, and I'm not seeing that completion get smashed off a cliff. It's actually the private companies, they've really, despite oil prices going down, they took the signal from the Trump administration and just said, let's go. And so we've actually seen that kind of hold up a little bit more than I think people thought. So from a rock perspective, absolutely. I'm not worried about maintaining that. But do we have to maintain somewhat of the rig count and the frac activity? Absolutely. On the frac side though, the horsepower for frac it's almost double what it was 5 years ago. Not quite double, but in some cases nearly close. So we have not tapped the technological growth on frac in terms of horsepower and efficiency, and the levels of where people are drilling, completing 3 wells at once. Like we have not seen that expansiveness yet. And so that has a lot of running room left, and that's super, super exciting from the nerd and rock perspective and what we have left to give.
So we have 3 minutes left. So I kind of want to wrap this up and just kind of ask an overreaching question over everything that we've talked about. What keeps you up at night?
So the two biggest things I would say is that, I honed in a lot about on the power side, it's power generation. It's not getting that right. It's cost of electricity, and it's people not appreciating that maintaining 13.6 million barrels a day, how meaningful that is. Like, our country this is the one sector in the U.S. that we are an industrial powerhouse. We are crushing it. And we need to do a better job as an industry. I'm still very upset with the industry for not leading, for not talking about it more, for not, leading the charge and owning it. I still, ESG metrics tied to pay at public oil companies, that keeps me up at night, drives me nuts. Honesty in the space, and then I would say, and that the biggest thing that this all comes back to China, is the one thing we're winning on is energy, but we don't seem to translate that to power generation, and realizing that if we don't win on power generation, we're not going to win with China. And so that's a really, the power generation, getting that right, and understanding how we compete with China, that's a really, really big one. Getting the average person to understand that, and then getting companies to realize, what this all means for their business and how they think about it, and that it's not actually that far out. When I go to London, I was there in May, and I was meeting with folks in Whitehall, and they were telling me they can't even get members of parliament to even conceive that there could be a conflict with China in the future. Talk about a heavy lift. Like, if you can't even get your members of parliament to even think about a potential conflict, it's really hard to actually do the things you need to do in a country just to get energy right. So those are the things that keep me up at night, worrying about, if we have a conflict, who the hell is with us on this conflict? And we desperately need, folks like the UK. So I'm hoping Trump is having some straight talking with Keir Starmer and some others in the UK.
Well, Trisha, thank you so much. This was very enlightening. This was wonderful. For everybody, go check out her podcast, PetroNerds. It's wonderful. She does a great job of keeping you updated on current events. And is there any way for, if people have more questions, that they can get a hold of you?
Yeah, absolutely. So I put cards up front. You can come up to me and get a card. I put a lot of stuff on LinkedIn, so I try to put short synopses, and so a lot of people follow LinkedIn or don't listen to the podcast. The podcast is a nice deep dive and gets you pretty current, and then lots of short videos and stuff on LinkedIn, but you can reach out to me, email me, and appreciate you guys and your time. It's been awesome. Thank you.
Thank you.